All right, let's stay on the jobs report and bring in James McCann. He's a senior global economist at Aberdeen Standard Investments. James, you've had a chance to look through some of the numbers. You've heard us discussing our views on this report. I'd just like to start with your high-level takeaways on what this report says to you about the state the U.S. economy finished 2020 in.
Yeah, look, I think it's obviously a weak report. And I think, as you've all highlighted there, very, very clear COVID flavor to this report, and a sense that we're going into and are in what is going to be a really challenging winter, regardless of what we're able to do on a vaccine over the next few months, regardless of what we're able to do in terms of short-term stimulus. These COVID disruptions are real. There are no signs that the COVID surge is getting any better for the time being. And I think we have to buckle down and get ready for a few months of really quite difficult data. I think the market might continue to try and look beyond that, but certainly there is a risk that some of the earnings hits from this start to rack up.
And I'm also curious, James, when you look at the more permanent effects, right? We attribute a lot of this to the pandemic, but you wonder what kind of long-term underlying damage is being done to the economy. One of the numbers that I've been watching with interest is the number of people not in the labor force who currently want a job is 7.3 million. And are there sort of the fundamental changes that are happening that are maybe masked by the pandemic or exacerbated by the pandemic, but ultimately will continue beyond it?
I think this is one of the things to be really concerned about. And there's a lot of optimism around the ability of the economy to rebound, as in part it did last year when restrictions started to ease, stimulus came in and growth kicked back quite strongly. But we do need to worry about some of the potential scarring that this pandemic might leave. And absolutely, you're right. There's a huge chunk of people who are sort of hidden unemployment. They're not counted in the headline unemployment rate because they've simply left the labor force. Now, some of that is COVID related. They're having to care for family members. Their career prospects are severely diminished. And hopefully there could be some relief from a COVID perspective if we are to see a successful vaccination. And it means a restriction on their sector, on their profession, their requirements to care for children or for relatives, etc., are not as severe. But I think there is a real risk that the longer this rolls on, with this being now the second wave, that you start to see a little bit more structural damage creeping in. And it's really what I think makes it important that some of those stimulus efforts really try and build back. So it's not about providing just short-term support. It's also about providing a long-term program, let's say around infrastructure investment, which starts to build back new types of jobs if we're right that there's structural damage done here. And you need not just a snapback, but you need a shift in direction for the economy.
James, listen, I know you're not a bottoms-up stock picker guy, but when you see a report like this, a real month-over-month change in how the U.S. economy is doing, do you think it squares with an S&P 500 trading at a record high priced earnings multiple? Does that make sense to you? Does that multiple need to come in off a report like this?
I mean, I think that the issue is that the market is definitely looking beyond this shock. It's absolutely factored in a degree of weakness over the next few months, but its focus is still on the ability of the vaccination program to deliver herd immunity in the US over the next 12 months. I think it's optimistic on that. I think over the last few days, it's become increasingly optimistic on the amount of fiscal support that's set to push through the economy. I think it's still hopeful and believes that the Fed will continue to support for a number of years yet. So I think the market is still focusing on those sort of medium-term drivers. I think it has in its mind that the next few months will be weak. I think that's baked in to some extent. But we need to be careful, first of all, that some of those drivers that it's based on don't disappoint. We've seen a slow start to vaccination programs. We're still a long, long way from herd immunity. We need to be careful, too, that some of the hopes around democratic ability to use a unified Congress aren't disappointed. They have a wafer-thin majority. What can they actually get done in this environment? And we all need to be cognizant, too, that there are new variants of COVID. Back in the UK, we're seeing cases surge really, really rapidly. And if that new variant comes to the United States, it could be the case that this winter disruption is even more severe. So, I think the market's focus will continue to try and be on that medium term, but it's not guaranteed. It needs to keep looking at those fundamentals that it's basing those expectations on.
James, I just want to ask you about the manufacturing, the hard goods side of the economy that we saw in this report continues to perform so well. And if you look at PCE spending towards goods, I mean, it's up, I think, 10, 15% over where it was when 2020 started. Is that momentum sustainable on the one hand, and on the other hand, is this maybe showing that some of those pent up demand theses may indeed come through, because there's a number of issues, inventory levels, so on and so forth. But the strength in the manufacturing and the goods side of the economy continues to really impress.
I think that's still, though, a reflection of what we saw back in 2020, in which you had this huge surge, which you just referencing good spending, as people couldn't go out and spend on services, they couldn't go out to restaurants, they couldn't travel in the same way, they couldn't do leisure activities, so they did. They bought stuff, and we've seen this big hit to inventories. And I still think we're trying to correct through that. And there's certainly a case that with this, further restriction on activity, with the winter, not lockdown, but with the winter restrictions that we're seeing, people lean back on that again and are still shifting their consumption towards goods. I do think the challenge for that comes maybe in sort of 6 to 12 months as people are able to reorientate their spending back towards services. I'm interested to see then if you start to get a changing of the baton and it's services companies that start to pick up at the expense of the goods companies. But I still think we're experiencing that sort of lagged mini cycle, as you had a huge depletion in inventories and stocks, and the industrial sector globally is still sort of rushing to try and catch up with that. And I think there's a few months left of that. So that's one bright spot of the economy, at least through all this.
James, I have 30 seconds left. When is the U.S. economy back to creating jobs? What month?
I would expect it to be not in the too distant future. I would expect it to be perhaps around, let's say around March. I think the next couple of months will probably be very weak. It could be negative. It could be very mildly positive. I think a real jobs recovery probably only really kicks in when you start to see significant easing in the pace of COVID expansion, and you're able to start taking your foot off some of these restrictions. I think that feels to me to be the next trigger.
All right, James McCann, Senior Global Economist at Aberdeen Standard Investments. James, really appreciate the time this morning. Great to talk with you.
Thank you.